So it's way less bullish than the previous three. So my best idea is Kimberly Clark. And the reason I like it is because I don't like anything else. I don't like cash. I don't like bonds. I don't like areas of the market that have done well. I don't like stocks that are already up 25 or 50%. So what you've got with Kimberly, which by the way, we all know what Kimberly does. They make Kleenex, Huggies, toilet paper. They make Scott's toilet paper, and then the higher end Cottonelle toilet paper. But the stock is down 20% over the last 52 weeks, 9% year to date, trades at about 16 and a half times earnings, has a 4.2% dividend yield. And come May, people are going to keep using their products. There's just a huge amount of economic insensitivity. So this is where I want to hide out in the fourth quarter. Oh, and by the way, even though I don't like anything else, I still think stocks are better than bonds and cash right now. So that's my hideout play.
All right, so I know you're a dividend investor, so obviously the 4% dividend is part of the reason why this company is attractive, but it's also a consumer staple, a bit of a defensive play. So I know you say you don't like anything, but still stocks are better than the alternative. But why go so defensive when you see something like the utility sector, which is also seen as defensive, hitting new all-time highs and also offering a dividend and the idea of rate cuts that might actually increase the dividend and make the stocks move higher as well? Why go to something very defensive that even you admit is trading lower?
So in our portfolio, I also own Dominion. I also own Clearway Energy. I love those stocks too. And those are the utilities that I like. I actually sold NextEra Energy a couple weeks ago, or maybe it was even just last week. And I sold NextEra because it's utility. It's a great place to be, but it's also trading at 23 times earnings and has 8 to 10% earnings growth, which I think is a little too expensive for that kind of earnings growth. Within the utility sector, there's huge divergence because of this whole data center boom and the insatiable need for endless energy. So that makes it tricky, and I think you need to be really careful. I wouldn't buy the utility index overall. I think it's up about 17% year to date overall. So you can pick some out, and I do like Dominion and I do like Clearway also.
Right,
I just like Kimberly better right now.
I understand. I want to go back to your pick. Obviously, as you mentioned, they make Kleenex. They make
so exciting.
Toilet. I know it's not the most exciting company ever. They make toilet paper as well, but I do have to ask you. We just hit on the Fed's Beige Book, showing that tariffs are increasing the cost of things. Now, I know a lot of these products are probably made domestically, but are you worried about some of the pressure on the consumer and the fact that they may not have the pricing power to raise prices and deal with some of the inflation?
So not for Kimberly. And as part of my research process, I was also looking at Clorox, because Clorox superficially looks about the same, also about a 4.2% yield, a little more expensive, maybe 18 times earnings. But in that research process, what I realized is there's so much less economic sensitivity in the purchases and the buying of Kimberly products versus even a Clorox, because if the consumer gets pinched, if the economy gets weaker, you will downgrade from generic Windex from regular Windex to generic Windex, for example. But you might downgrade from Cottonelle to Scott's. You're still in the Kimberly family. There's just less sensitivity when you're buying Kimberly's kind of staples versus many others. So that's what attracted me to this one.